The United States government is spending money they don't have at the fastest rate we have seen since the pandemic. And now this money printing can't be stopped. This creation of money out of thin air, the money printing causes inflation. It causes the value of our dollars to go down. It creates a bigger wealth gap because the average person gets poorer because of this inflation, while the 1% or the 0.1% becomes extremely wealthy. And it creates some concerns about the United States dollar potentially losing its status as the world's reserve currency. And this is where everybody with common sense will tell you, why don't we just stop this money printing so we stop having these problems? There's just one small problem. The government can't stop. We as a country have become addicted to this money printing. And when you're addicted to anything and you take it away, there's going to be consequences. And my team did some research, and what we found is that if we stop this money printing, we would see the biggest recession that we have seen since the Great Depression. Let me show you what I mean. The 2008 Great Financial Crisis was the biggest recession that we have seen in the United States since the Great Depression back in the early 1930s. And what we saw during the 2008 Great Financial Crisis is that our economy, which is measured through a number called GDP, fell from around $14.5 trillion at the peak to around $13.8 trillion at the bottom. Now, GDP is a measure of all spending that happens in the economy. So when you go to Chipotle and you buy the extra guac, well, those numbers show up in the GDP. When Amazon goes and opens new factories in the United States, that number shows up in the GDP. And when the United States government spends money, that shows up in the GDP. So over this 2008 Great Financial Crisis, during the biggest recession that we have seen since the Great Depression, we saw our economy fall by around 4.3% from top to bottom. Now let's compare this to what we're seeing happen today. The United States economy in 2025 is expected to hit $30 trillion big. Again, that is our GDP, which is a measure of all spending. So when Nvidia spends more money, that shows up in the GDP. When you buy the extra guac, it shows up in the GDP. And when the government spends more money, that also shows up in the GDP. But this is where things get interesting, because in 2025, it is anticipated that the United States government will generate $5.2 trillion in taxes, which essentially means that $5.2 trillion of our GDP comes from our own tax dollars. So you pay taxes and that money gets reinserted back into the economy by the United States government. But the United States government doesn't run a balanced budget. That's why we have such a large national debt, because the government keeps spending money that they don't have. So the United States government is going to collect $5.2 trillion in taxes. They're going to spend all that money, and then they're going to spend some more, because it is estimated that the United States government will spend around $7 trillion in 2025. That means $7 trillion out of this $30 trillion of spending that's happening in our economy is coming straight from the United States government. Out of the $7 trillion, $5.2 trillion is coming from your tax dollars, and then the other $1.8 trillion is coming from debt. That's deficit spending. Now the question is, where is the United States government actually borrowing this money from? Well, they can borrow this money from people like you and me when you lend your money to the United States government in exchange for interest payments. They can borrow money from foreign countries like China and Japan and the United Kingdom when they want to save and invest their money in the United States. Or they can borrow this money from the Federal Reserve Bank, which is the central bank here in the United States. Now, this is where things get even more interesting, because although they're called the Federal Reserve Bank, they're actually not a bank, because you and I can't go there to deposit money. They're not a reserve because they're not sitting on any cash reserves, and they're not federal. It says so on their website that they're not a part of the federal government. So if the Federal Reserve Bank is not sitting on any cash reserves, it's not sitting on any money, how do they lend money to the United States government that the government can then go out and spend? Well, the Federal Reserve Bank has the ability to create money out of thin air. The Federal Reserve Bank is the entity that's actually printing the money. It's not the United States government itself. So the Federal Reserve Bank then goes out and prints this money out of thin air. They lend it to the United States government. The government can then spend that money. It boosts the economy. But then we have the consequences of money printing, which I talked about in the beginning of this video. And this is where everybody says, why doesn't the government just stop this deficit spending? If we ran a balanced budget, well, now we don't have to worry about any of this problem. We don't have to worry about inflation, because the government is spending within its means. I mean, we all have to spend within our means. Why can't the government do the same thing? Well, if the government did that, that would mean essentially the government would lose out on $1.8 trillion of spending, which means our GDP would shrink from $30 trillion down to $28.2 $2 trillion, which if we do the math, if our GDP falls by $1.8 trillion, that would mean that our economy would contract by around 6%. Why does that matter? Because in 2008, when we saw the biggest recession since the Great Depression, our economy contracted by 4.3%. This would be a 50% worse recession than that. This is why it is so difficult for the United States government to stop this money printing, to stop this deficit spending, because it would cause economic pain, the likes of which most of us have never even experienced, or even our parents have experienced. Now, if you've been watching my channel at all, you understand that this is why it's so important for you to become an investor, and I want to remind you that for those of you that are investors or want to become investors, I put together a brand new investing masterclass where I walk you through how you can find hidden investment opportunities before everybody else. I'll show you how you can start investing your money, and I'll lay out the exact framework that my firm uses to research investments and find investment opportunities before they hit the headlines. It's a completely free masterclass. There's a ton of value in there, and when you register for the masterclass, we're also going to give you access to Market Briefs, which is my newsletter for investors, for free at no additional cost, just complimentary. So if you want to get the investing masterclass and Market Briefs all for free, all you have to do is click the link down in the description below to get it all. So let's take this one step further. Let's talk about what the United States government can do, and let's talk about how you can win no matter what the United States government does. Running a balanced budget does not happen without sacrifice, and there's really only two ways to do it. You could either spend less money or you can work to earn more money. In the early part of 2025 with Doge, remember Doge? There was a lot of talk through the Trump administration to wanting to cut government expenses, wanting to cut government waste, so people were being laid off, departments were being cut, and funding was being reduced. Why? As a way to reduce government spending, although there is a cost and there is a pain to always reducing spending. But when you keep increasing spending other places while you're cutting places somewhere else, it doesn't actually cause a net reduction in spending, and that's what we're seeing happen, that the United States government is still on pace to have about a $1.8 trillion deficit in 2025. So one thing that you can do is reduce spending, but the reduction in spending does not come without economic pain, because that means people would lose their jobs because they no longer are going to be paid by the government. That means companies are going to lose funding from the United States government. That means departments are going to lose funding. It is painful, but ultimately, we have to decide what's more important. Do we want to keep the economy moving, or do you want to preserve the strength of the dollar? And that's why recessions are unfortunately a necessary part of our economic system, because the economy has to reset when you create all these bubbles out there. The other part of that is to increase revenue. So you can either cut spending or earn more money. Well, in the United States government's case, that will be earning more tax dollars. But the problem to that is people don't like paying more taxes as it is, and people are already paying a lot of money in taxes. Take a look. As a licensed attorney who's not your attorney, here's a small list of taxes that many Americans are paying. You are paying an income tax. So as soon as you go to work to get paid, some of that money is going to be withheld for taxes before you even see that money. Then you have your payroll taxes. These are your FICA taxes, your Social Security taxes, your Medicare taxes that you're going to be paying on your income, again, before you even get that money in your pocket. Then you have your sales taxes. You go into the store, you want to buy something, you got to pay a sales tax. Then you have a property tax. You buy a house, great. But you got to pay property taxes for every year that you own the house. Then you have capital gains taxes. If you invest your money in the stock market and you sell that investment for a profit, or you start to get dividends, well, now you have to pay investment taxes, which are called capital gains taxes. Number 6 are estate taxes. This is also known as the death tax. Now, this is more reserved for the ultra wealthy, but if you were going to pass down wealth to the next generation, you have to think about this estate tax. Then are tariff taxes. If you are a business or you're somebody who's buying products from a foreign country and there's a tariff on that country, well, you have to pay that tariff tax when you import that product into the United States. Number 8 are corporate taxes. If you run a corporation and you make a profit, the corporation has to pay taxes on that money before you get a penny of profit in your personal bank account. So the corporation has to pay the tax, and then as soon as $1 hits your bank account, you now have to pay an income tax on the money that you made. So it's called double taxation, because now the corporation pays taxes and then you pay taxes on that same money twice. Then you have your state and local taxes. Many states, many cities have a tax that if you live there, you have to pay. And then I just lumped everything else in the other tax, because if we listed every tax, this would go on forever. But other taxes are things like your toll taxes, your cigarette taxes, your alcohol taxes. I just kind of lumped everything else here. So the problem that we've identified is when the government spends money that they don't have, that creates money printing by the Federal Reserve Bank, which causes inflation. That inflation problem devalues the dollar. That creates the concern of a widening wealth gap. The average person gets poorer, the financially savvy, the investors become wealthier, and that creates concerns about the United States dollar losing its status as the world's reserve currency. Why is this happening? Because all this deficit spending is there to boost the economy, and we've become addicted to this spending by the United States government. Well, how do we resolve that? Well, if we were to just cut all this deficit spending, it would lead to the worst recession that we have seen since the Great Depression, 50% worse than what we saw during the 2008 Great Financial Crisis. So how can we actually not come up with a solution? Well, if we were to cut some spending, there's going to be pain to that because that means people lose their jobs. That means businesses and entities would lose some funding. The alternative is to raise income through taxes. But the problem with that is people are already paying a lot of taxes, and it's not easy to encourage people to pay more dollars in taxes. So with this problem being there, what does this mean for you? How do you win in this economic system? And because we can't control what the government does, what you can control is how you react to this. That way you can win no matter what happens in the economy, because the reality is we're going to continue to see volatility. We're going to continue to see inflation. And you want to be in a situation where you can win no matter what happens. And this is where being a financially savvy investor is one of the best things that you can do, because what we have seen throughout history is that inflation generally benefits the investor. Why? Because as more dollars are created, those dollars go into the hands of the businesses. And when I say into the hands of the businesses, I don't just mean the employees, I mean the owners of those businesses. And who are the owners of those businesses? It is the investors of those businesses. Now, the unfortunate part is most of us, myself included, never learned this in school because, well, we're not taught financial education, we're not taught investing education. But once you understand this, you can start to see why it is so important for you to become an investor, because if you want to build wealth over the next decade, over the next 3 decades, you have to be an owner of the economic system. Now, the real difference between investing now versus 50 years ago is that it is so much more important to have real diversification now with the concerns about inflation and where the dollar is going to go over the next 50 years that we didn't really have 50 years ago. So let me break this down, but I gotta give you the disclaimer, which is investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. I'm going to give you 7 ideas of what this could potentially look like, starting with just investing your money into the broad American economy, because what we've seen over the last 50 years and the last 100 years is that the stock market in the United States has grown by around 10% a year. Yet the average person who's throwing their money into the stock market is losing money. Why? Because most people don't know how to invest, they don't know what to invest in, and they don't know what they're doing. They get emotional. Well, there are ways for you to just own a piece of the United States economy. I'm going to give you a couple examples. Again, I'm not telling you what to invest in. I'm just a random guy on YouTube, just giving you ideas. If you were to invest your money into the VTI fund, you were getting exposure to the total stock market. This is an ETF, meaning it's a fund that you can buy on pretty much any stock brokerage. And there are more than 2,000 stocks in the United States. So if you buy 1 share of VTI, you're getting exposure to the 2,000 plus stocks in the United States stock market. If you wanted to get a little bit more niche, let's say you wanted to invest in the S&P 500, which is not the total stock market, it's just investing in the 500 largest companies in the stock market. Well, you can invest in a fund, an ETF like SPY. Again, pretty much any stock brokerage will allow you to invest in something like SPY, but now you're getting exposure to the 500 largest companies instead of all the companies. And if one of the companies started to struggle in the S&P 500, well, this fund would automatically kick them out and replace it with another company, and you don't have to do anything, so it's completely passive for you. Option number 2, also in the stock market, is to get more involved just on the technology side of things. Now, I've been learning so much about AI in 2025, and I can tell you that there's a crazy world changing with AI and technology. There's a lot of money flowing into it. Chances are we are in a bubble, and chances are this bubble will burst at some point. And when it bursts, a lot of people are going to cry and scream and complain, but AI is not going to go away. it will then restart and the strong AI companies will thrive in the future. Kind of like how in 2000, the dot-com bubble burst, and then a lot of dot-com companies failed and went bankrupt, but the strong companies then were able to not only just survive, but then thrive. So if you wanted to get more exposure to tech, understand it's going to be much more volatile, but there's more potential upside there as well because there's a lot of money flowing into tech and there are funds that can give you exposure to tech. For example, QQQ. This is an ETF that gives you exposure to the NASDAQ 100. What is that? That is a group of the 100 largest companies in the stock market that are not financial. Notice how it said not financial. That's the key part of the NASDAQ 100 because of those 100 largest companies that are not financial, most of them are technology companies. So if you wanted to get exposure to tech, this is one way to do that. Just understand that this comes with more volatility. Next time we see a recession, because we know that recessions happen, we know that market crashes happen, they're going to continue happening. This is going to hit probably worse than these, but if you understand the way that market cycles work, this can also create more upside when that rebound happens. Idea number 3, also in the stock market, is to invest your money into developed foreign countries. So if you wanted to diversify outside of the United States, there are funds in the United States that will give you exposure to developed countries outside of the United States. That way you can diversify your money outside of the United States economy. For example, an ETF called VEA is created by a fund called Vanguard, and this will give you exposure to developed countries outside of the United States. That way you're not just fully invested your money into the United States economy. Idea number 4, this is the last one for the stock market, is to invest your money into emerging markets. Emerging markets are kind of like foreign markets, not in the United States, but these are the smaller countries, the more kind of growing countries. So more risky here than here, but you have more potential upside because not only are you investing in these companies that are trying to grow, but the countries are also rapidly trying to grow. But it's more risk because, well, these emerging markets don't have the same security with as strong of a military. Their economy might not be as robust, so it creates more risk for more potential return. But again, a way to diversify your money outside of just the United States economy. And an example here is a fund called IEMG. Again, pretty much every stock brokerage will allow you to invest in these types of ETFs that will give you exposure to these types of emerging markets. Now, one more time, there are many different types of funds out there. I'm just giving you a few examples to help you start your research, not telling you what to invest in. But now, as we diversify outside of the stock market, you have option number 5, which is investing your money in real estate. Now, real estate is a real diversification outside of the stock market because this is not a paper asset. When you go out and you buy a rental property, you buy the land, you buy the bricks, you buy the window, you buy the roof, something you can see, feel, and touch, versus when you buy a share in, say, Amazon, you buy a piece of paper that says you own 1 share of Amazon, but you can't actually do anything there. So when you buy real estate, it is a real form of diversification. And now what you're doing is you're protecting yourself against the stock market crash, because if stocks go down, maybe real estate doesn't go down to the same extent or at the same speed, or maybe real estate doesn't go down. Like during the 2020 pandemic, we saw stock prices fall by 30-some%, but real estate didn't. So when you have this type of real diversification, the goal is to be able to invest your money in different places. So if you see a recession or a crash in one asset class, not your entire portfolio is going to be hit the same way. Now, when you're investing in real estate, I like to invest for cash flow, not appreciation, which is I want to buy a property for rental income, and I want to use that rental income strategically to pay for all of my expenses and put some money in my pocket every single month. That way I can work to acquire more rental properties that are going to keep paying me year after year after year. And if you do it right, you can build a good team with a good property manager, so it's pretty passive for you. It took me a few years to learn how to make it passive, but once you make it passive, well, it can be a great stream of income while owning a hard asset, while getting some great tax breaks, because again, as a licensed attorney who's not your attorney, I can tell you that real estate has some of the biggest and best tax breaks that our tax code has to offer, which is why you have some very wealthy people earning millions of dollars a year from real estate, paying $0 a year in taxes, because that's what the tax code allows you to do. But I'm not going to go too deep into the real estate tax side of things in this video. Idea number 6 is to invest your money into physical gold. This is another form of real diversification because it is a completely different asset class. And when I invest my money into gold, I don't look at it as an investment. I really don't care what happens to the price of gold. I look at gold as a form of saving hard money. That's the way that I think about it, because the way that I think about it is if I were to save $10,000 of cash and I had $10,000 of physical gold today, and I buried these two things in my backyard today, I think my theory is that the gold is going to have more buying power than the cash in 10 years. Am I going to be right? I don't know. But that's why I save a little bit of money, about 2% of my portfolio, in physical gold as a form of insurance, as a form of protection. But this to me really isn't an investment because it's not actually producing any value. That gold is just sitting there not doing anything. And then investment idea number 7 is more speculative. This would be like investing your money maybe in startups. This would be like investing your money maybe in cryptocurrencies or Bitcoin. Alternative types of assets, again, different asset classes, more speculative because they, more risky, more potential return, but it's a different asset class. That way you can protect yourself if the stock market goes down. Maybe a different asset class won't. Maybe it won't go down as much. Maybe a different asset class will go up as the stock market is going down. It just depends. But when you have this type of real diversification, well, now you're able to protect yourself against more volatility, against major swings in the economy, and against major swings in the dollar as well. So in this video, we talked about why inflation happens. We talked about why it's so hard for the United States government to stop the money printing. We talked about how it's actually the Federal Reserve Bank that's doing the money printing, not the United States government, because the government is the one that's spending the money. We talked about how to solve that problem by either spending less money, which is painful, or earning more tax dollars, which is also painful. And regardless of what the government does, the way that you protect yourself is by being a financially savvy investor, because that's how you're going to win no matter what happens in the system. Again, for those of you that want to become investors or are investors, I have a free investing masterclass, which I've linked for you down in the description. And that's how you can win in this economic system. Now, if you got value out of this video, the best thank you is to share this video with a friend, a colleague, a family member, or a fellow investor. The United States government owes more than $37 trillion. That means your tax dollars are being used to pay interest on all that debt. And this is where President Trump has been proposing a new plan to help pay off this debt involving gold and involving crypto. And most people have no idea of how this plan works or the implication of this new plan on your money.